September 15th, 2008. The lights are still blazing in the Lehman Brothers headquarters in Manhattan. Inside, 25,000 employees are about to wake up to a nightmare. By sunrise, the 158-year-old investment bank will file for the largest bankruptcy in American history. The shockwave will nearly destroy the global financial system. This is the story of how one of Wall Street's most prestigious firms collapsed in spectacular fashion, and how its fall triggered the worst economic crisis since the Great Depression. Lehman Brothers was founded in 1850 by 3 German immigrant brothers in Alabama. They started as cotton traders and gradually built themselves into a Wall Street powerhouse. By the early 2000s, Lehman was the 4th largest investment bank in America. But in the late 1990s, everything changed. Richard Fuld became CEO in 1994, and he transformed Lehman into an aggressive risk-taking machine. Fuld was nicknamed the Gorilla for his intensity and competitive drive. Under his leadership, Lehman's profits exploded, and so did its appetite for risk. The key to Lehman's strategy was leverage. In simple terms, leverage means borrowing money to make investments. If those investments pay off, you make huge profits. If they don't, you're in serious trouble. By 2007, Lehman was operating with leverage ratios of over 30 to 1. That means for every dollar of its own capital, the firm had borrowed $30. This was financial dynamite. And what was Lehman investing all this borrowed money in? Real estate. Specifically, mortgage-backed securities and commercial real estate. In the mid-2000s, the American housing market was booming. Home prices were rising year after year. It seemed like a sure bet. Here's how the mortgage-backed securities game worked. Banks would give out thousands of home loans to borrowers. Then they'd bundle these mortgages together and sell them as securities to investors. Lehman Brothers was buying these securities in massive quantities and creating their own. It was incredibly profitable, as long as homeowners kept making their payments and house prices kept going up. But there was a problem. The quality of these mortgages was declining. In the rush to make more loans, banks started giving mortgages to people who couldn't really afford them. These were called subprime mortgages, borrowers with bad credit, no down payment, sometimes no proof of income. They were getting loans they had no realistic chance of repaying. Wall Street didn't care. The banks that originated these questionable loans would immediately sell them off to be packaged into securities. They collected their fees and passed the risk to someone else, and firms like Lehman Brothers were happy to buy them because they were making enormous profits. By 2006, warning signs were appearing. Home prices stopped rising in many markets. They started to fall. Suddenly, homeowners found their mortgage payments skyrocketing. Many couldn't afford them. Foreclosures began to climb. The borrowers who should never have gotten loans in the first place started defaulting in large numbers. The mortgage-backed securities that Lehman owned began to lose value, but Lehman's leadership didn't pull back. They doubled down. In 2007, even as the subprime crisis was beginning, Lehman invested billions more in real estate. They believed the crisis would be contained. They were catastrophically wrong. In March 2008, Bear Stearns, another major investment bank, collapsed. It was bought by JPMorgan Chase in a government-backed rescue. This should have been a massive red flag for Lehman. Instead, Lehman executives publicly insisted they were in great shape. Behind closed doors, panic was setting in. Lehman's balance sheet was loaded with toxic assets that were plummeting in value. The firm tried to hide the extent of its problems using accounting tricks to temporarily move assets off their balance sheet before quarterly reports. These maneuvers, later called Repo 105 transactions, would become the subject of fraud investigations. Throughout the spring and summer of 2008, Lehman desperately searched for ways to survive. They tried to raise capital. They looked for investors or buyers. They had discussions with the Korean Development Bank, Bank of America, and Barclays. Nothing worked out. Meanwhile, short sellers on Wall Street smelled blood. They were betting that Lehman's stock would fall, which created a vicious cycle. As the stock price dropped, confidence in Lehman evaporated. Clients started pulling their money out. Other banks became unwilling to do business with them. It was a classic death spiral. By early September 2008, Lehman Brothers was running out of time. The firm needed either a buyer or a government bailout. Richard Fuld and his team believed the government would step in. After all, the Federal Reserve and Treasury had rescued Bear Stearns. Surely they wouldn't let Lehman fail. The consequences would be too severe. That weekend of September 13th and 14th was probably the most dramatic in Wall Street history. Treasury Secretary Henry Paulson and Federal Reserve Chairman Ben Bernanke brought together the heads of all the major banks. The message was clear: find a private sector solution for Lehman. The government would not provide a bailout. Two potential buyers emerged, Bank of America and Barclays. Both conducted due diligence on Lehman's books. What they found was worse than anyone had feared. Lehman's losses were enormous. The toxic assets on the balance sheet were essentially worthless. Bank of America walked away and bought Merrill Lynch instead. Barclays wanted to make a deal, but British regulators refused to approve it without a government guarantee, which the US Treasury wouldn't provide. By Sunday night, it was over. Lehman Brothers would file for bankruptcy the next morning. The decision shocked the financial world. Many had assumed Lehman was too big to fail. They were wrong. Monday, September 15th, the markets opened in chaos. Lehman's bankruptcy filing listed over $600 billion in assets and debts. The Dow Jones plummeted 504 points. But the real catastrophe was just beginning. Lehman Brothers wasn't just another bank. It was deeply woven into the fabric of global finance. The firm had over 1 million derivative contracts with thousands of counterparties. When Lehman went bankrupt, nobody knew who would take the losses. Trust between financial institutions evaporated overnight. The credit markets froze. Banks stopped lending to each other, terrified that the next one might fail. Businesses couldn't get the routine loans they needed to make payroll or buy supplies. The entire financial system was on the verge of collapse. Within days, the government had to rescue AIG with $85 billion. Washington Mutual failed. Wachovia had to be rescued. Morgan Stanley and Goldman Sachs teetered on the edge. The crisis spread to Europe, where major banks failed or required massive bailouts. By late September, Treasury Secretary Paulson and Fed Chairman Bernanke went to Congress with a terrifying message. Without immediate action, the entire financial system could collapse within days. Congress quickly passed the $700 billion Troubled Asset Relief Program to stabilize the banks. But the damage was done. The Lehman collapse turned a financial crisis into a full-blown economic disaster. Credit dried up for businesses and consumers. Companies laid off workers by the millions. The stock market lost half its value. Home prices crashed. The United States entered the worst recession since the 1930s, a crisis that would become known as the Great Recession. Unemployment soared to 10%. Nearly 9 million Americans lost their jobs. Millions more lost their homes to foreclosure. The economic pain spread around the world. Europe fell into recession. Global trade collapsed. It would take years for the economy to recover. So who was responsible? In the years after the collapse, investigators and the public searched for someone to blame. Richard Fuld became a symbol of Wall Street greed and recklessness. He was called to testify before Congress, where he faced withering criticism. But he was never criminally charged. In fact, despite the catastrophic fraud and recklessness that led to the crisis, very few Wall Street executives went to prison. The complexity of financial regulations and the difficulty of proving criminal intent made prosecutions challenging. This lack of accountability would fuel public anger for years. Many also blamed the government's decision to let Lehman fail. Treasury Secretary Paulson later said he didn't have the legal authority to bail out Lehman. Critics argued this was a mistake that turned a manageable crisis into a catastrophe. The debate continues. Should Lehman have been saved? The truth is, Lehman's collapse was the result of failures at every level. Lehman's executives made reckless bets and hid their problems. Credit rating agencies gave top ratings to toxic mortgage securities. Regulators failed to rein in dangerous practices, and the entire financial system had become too complex, too leveraged, and too interconnected. In the aftermath, Congress passed the Dodd-Frank Act, the most significant financial reform since the Great Depression. Banks were required to hold more capital. New rules limited risky trading. Consumer protections were strengthened. September 15, 2008 was a day that changed history. The collapse of Lehman Brothers revealed the fragility of the modern financial system and the terrible cost of unchecked risk-taking. It destroyed trillions of dollars in wealth, cost millions of people their jobs and homes, and shook public faith in both Wall Street and government. Today, the Lehman Brothers building still stands in Manhattan, but it houses Barclays now. Richard Fuld, once worth hundreds of millions, saw his fortune evaporate. the lessons of Lehman Brothers remain urgent. Financial crises don't happen in isolation. They're built slowly through years of excessive risk-taking and regulatory failure. By the time the crisis becomes obvious, it's often too late to prevent catastrophe. 15 years later, we're still living with the consequences of that September morning when Lehman Brothers fell and took the global economy down with it.